Ditch the hype, build wealth. This video unlocks the investment philosophy that shaped legends like Warren Buffett. Warren Buffett's journey to becoming one of the most successful investors in history began surprisingly young. At the precocious age of 11, he took his first steps into the world of finance.
I had started investing when I was 11. I just dithered away until when I was 7 and 8 and 9. So unfortunately, I didn't get started until I was 11. But I bought my first stock when I was 11, and then I experimented with a whole bunch of things, like timing of stocks and charting and doing all these crazy things. It was a lot of fun. Profitless, but a lot of fun. And I did that until I was 19.
At the age of 19, Benjamin Graham's The Intelligent Investor proved to be a life-changing book for Warren Buffett in 1949. Two particular chapters within the book left a profound impact on Buffett's investment philosophy, instilling in him the importance of valuing stocks as ownership stakes in underlying businesses. The first thing Warren learned was forget price tags. Dive deep. Value investing isn't about the stock price, it's about the company's guts, profitability, debt, competition, management. He prioritizes a company's true worth over market noise. Learn how to invest like Buffett, the master of long-term gains, in Warren words.
In 1949, I read The Intelligent Investor by Ben Graham. I'd never heard of him up till then. And there are really only two chapters in that book that are the key to it. But they set my philosophical framework for investing in three ways. They're so basic and so simple, it's hard to understand how they could be that important, but the 10 Commandments are simple. The first is that a stock is part of a business. I mean, you can't think of a stock as something different. You value a business, and then you divide by the shares outstanding. But what you have to think about is what kind of a business are you getting into, what are its economic characteristics, who are its competitors, what's its management like, all of these things that relate to a business instead of a little ticker symbol. I used to know when I was 11 or 12 the ticker symbols of every company virtually on the New York Stock Exchange. I could mark the boards at Harris Upham, but I didn't know anything. I mean, I knew that X was U.S. Steel and G was AT&T and so on, but I didn't know anything. I didn't know what was behind them. So I had to start looking at these little symbols or these little names in the paper as businesses and decide, how do you value a business? What counts?
The second important lesson Warren Buffett offers is sage advice for navigating the emotional roller coaster of the stock market. He introduces us to the concept of Mr. Market, a whimsical personification of the market's ever-changing mood. According to Buffett, Mr. Market shows up at your door every day offering to buy or sell shares of your investments at sometimes wildly fluctuating prices. These fluctuations, Buffett argues, are driven by Mr. Market's emotions, not by the underlying value of the businesses themselves. The key for investors is to stay calm and collected, detaching themselves from Mr. Market's erratic behavior.
The second thing in the book is that Graham gives you a marvelous set point in terms of how the investor should react to stock market fluctuations. He talks about his mythical Mr. Market in Chapter 8. There's been no better thing written in terms of the investor's attitude toward stock prices. Most people react the wrong way to stock prices.
The third thing Warren learned is the margin of safety. Imagine you are an engineer tasked with building a bridge. You wouldn't just use the minimum amount of materials necessary to hold the weight of cars. You'd incorporate a significant buffer zone, a margin of safety, to account for unexpected stresses, heavy traffic, or future wear and tear. The same principle applies to investing.
Third thing in Graham's book is the margin of safety. If you come up to a bridge and it says capacity 10,000 pounds and you're driving a 9,800-pound truck, you drive down further and find another bridge. I mean, nobody knows exactly what that capacity is, and sign may have been put up 3 years ago, so you always leave a margin of safety. You don't try to cut things that close. You wait till something kind of shouts at you in the stock market.
By following these principles, Warren learned to build a strong portfolio for long-term success. The foundation, a shrewd business owner, is through stock ownership, focusing on the quality of businesses you invest in rather than short-term market fluctuations. This time-tested approach has helped countless investors achieve financial security and its wisdom remains valuable for anyone seeking to build wealth through sound investing strategies.